Alright, so in this teaching, we are going to talk about conquering hard time frame excellence. We're going to talk about the basic concept, the base concept rather, of my trading and the approach to high probability trading. The top-down analysis. Definition. The top-down analysis is the act of the analysis being based on a high time frame premise. As intraday traders, the monthly, weekly, and daily. So a top-down analysis, what it really is our analysis starting on a higher time frame chart. So if I trade on a 1 minute time frame, and if I frame my trade based on a 15-minute time frame or a 1 hour time frame, my analysis and the reason why I choose to look inside of that direction or for that trade idea in itself is based on a monthly, weekly, and or daily. As intraday traders, the weekly and daily will be used the most. Importance. The top-down analysis is the most important concept in high probability trading, as everything is based on the high time frame weekly and daily, removing all of the confusion from the lower time frame intraday, 1 hour, 50-minute, and 1 minute. So, when we have our analysis based on the higher time frame, based on a daily and weekly chart, the chances of us getting confused or us not being able to tell what the market is going to do are going to be significantly less if we base ourselves around the weekly and the daily. The main premise is that these markets, they move after the high time frame chart. The high time frame chart is king, and it absolutely dictates all of the movements from the hourly chart, from the 4-hour chart, from the 15, 1 minute, 15 second, and so on and so forth. Everything is based on these time frames, and the main reason why is because the tug of war between smart money and retail money is played inside of these time frames. So that is why most of our attention is going to be on our top-down analysis, analyzing the weekly and the daily. The top-down analysis, if used correctly, helps us identify times in which the market will not perform, allowing us the edge of knowing when to be sidelined to minimize losses. What does this mean? Well, inside of our high probability trading, inside of the narrative, because this is what it really is, it's a narrative. Inside of the narrative that we are only going to trade in the situations that are viable for high probability trading, this means not only identifying the days in which we're going to trade, which are going to be the best days to trade, but in the same time, the profits or the accumulated profits that we're going to have at the end of the year are going to be significantly impacted also by how many losses we've had across the entirety of the year. So if we can absolutely reduce the losses, and I do not say that you're not going to lose. I lose, you're going to lose. But our job as a trader is to minimize these losses, to minimize the frequency of these losses, and to be managers and to maintain our capital. Because if you are vested, or if you engage or you have engaged in the past in low probability trading, in which you are looking for high frequency trades, then you will know that most of the times you will end up either at the same price, and when I mean price, I meant to say same balance or same profits for the day, as you would if you would have taken one good trade. So that is the difference between a low frequency, high probability trading style and a high frequency, low probability trading style. It is also very taxing when we're talking about low probability. The most important thing when it comes to trading, it is mental capital. And low probability trading is very taxing when it comes to mental capital, because this is just a psychological game. So if you do not have the mental capital to trade for the next 2 to 3 weeks, then that is even more damaging than taking a financial loss in itself. So mental capital is also protected by having the basis of our premise inside of a daily chart. The top-down analysis therefore allows us to be highly selective of our trading environment, encouraging the trading during the distribution only. So, by being smart money traders, what we're going to look for is to trade inside of the distribution. When we're looking at the accumulation, manipulation, distribution concept, we understand that the highest degree of probability and the highest degree of explosion and the highest degree of easiness when it comes to identifying a move is through the distribution. So therefore, if we're going to look at a higher time frame chart and we can identify the correct direction and the correct time in which the distribution is going to start, and we only trade solely inside of that direction, then this is, my friends, the highest degree of probability trading. So, higher time frame charts. The time frames that we're going to look for if we are intraday traders are going to be the following. We're going to look at the weekly and the daily chart. And a high time frame chart than these two breeds confusion without detailed study. So you saw me going into the 3-month chart, you saw me go into the 1-month chart, you saw me go into the 6-month and 12-month chart, but that is not required. And for you to go in and try to identify the monthly bias or the 3-month bias or the 6-month bias and or the 12-month bias, it requires a very much experience when it comes to trading these concepts in this way. And if you don't have the experience yet, then you're not going to use them the correct way, and then you're going to identify a wrong bias, which is nothing wrong, but then you're going to be discouraged. So for intraday trading, I advise you to keep it on a weekly and a daily level. How they are used inside of a weekly chart. What we're going to do is we're going to anticipate a direction. So it is the anticipation of a direction, either higher or lower, or a consolidation, then only stick into that direction. So we pick a direction and we only stick to it, and we only trade within the week inside of that direction. For instance, if I anticipate the next weekly candlestick to go higher based off my narrative that we saw price do XYZ, which are institutional order flow signatures, having a higher target of W, which would be either a level of buy side or an inefficiency in the form of a SIBI, I will only choose to trade long for the next week of trading. And for a bearish bias, if I anticipate the next weekly candlestick to go lower, based off my narrative that we saw price do XYZ, which again are institutional order flow signatures, having a lower target of W, which would be a level of sell side, or a BISI in this case, I will only choose to trade short for the next week of trading. How they are used: daily chart. And I promise that we're going to also have an in detail example at the end of this recording, at the end of this lesson. Having a pre-anticipated bias from the weekly, we will only see the signatures for an X chosen day, higher or lower. And of course, while having proactive scenarios to deny our narrative. What do I mean by this? Based on our weekly bias, for the chosen day of, let me just give you an example, on Wednesday, what I will do is I will anticipate the markets will either go higher. In this case, let's just say it's going to go higher. I will only anticipate the market to go higher, and all of the institutional order flow signatures for that day, instead of a lower time frame chart, I will only see higher. I will want to see the market close above the CBs. I will want to see the market use the bullish order blocks as means of support. I will want to see the consequent encouragement of a wick being used as a means of inversion and being closed above. I would want to see three opposing PD arrays fail. I would want to see all of my bullish PD arrays to succeed. And if 3 of them fail, then what I will do is I will just sit on the sidelines, or if I'm more experienced, I will reverse my idea. And this took a lot of time for me to do. So the best thing that you can do right now is just stay sidelined, and what you have to do is you just tape read or you just study the market. For instance, based on my bullish predetermined weekly bias and narrative, understanding that the weekly manipulation has successfully formed the low of the week, which is LOTW, as a, I don't know, this is how I write it inside of my groups. So if I have LOTW, it is low of the week. I anticipate the market to trade higher through Y day if we do not do Z, institutional order flow signature. So based on my bullish predetermined bias, what I will do is I will anticipate the market to go higher for this day. And if we do this signature, that I'm going to stay out. There is absolutely nothing emotional when it comes to trading like this. And the same thing goes with the bearish bias. And I will save you some time, and I'm not going to go through it. But same thing, you can pause and read this one if you want to. Now, moving on into how we actually determine the weekly accumulation, manipulation, and distribution. The first rule that I want to talk about is that this is indeed a constant, but it is not an everyday or every week, rather, occurrence. The second rule that I want to talk about is I want you to allow yourself to make errors, as nothing is 100% in trading. This approach to trading might be very close to 100%, but it will never be at 100% because nothing is 100% in trading. The third rule we're going to talk about is respecting your rule sets, because they will pay off in the long term. The market will indeed go outside of these rule sets sometimes. And if the market expands into your targets in a day in which you didn't expect them, what you do is you just let it go. Yes, you just missed the movement. and you do not do anything about it. You just let it go. You will study it the next day and you will understand why the market did that. The market doesn't expand in a day you were expecting. You either didn't see something or you currently aren't that experienced to understand the exceptions, which is totally fine, as experience is just a payment of attention and time. So the market did not expect but the market did not expand in a day you were expecting it to, and you just took a loss. But what this means, and the only thing this really means, is perhaps you do not have the experience to recognize an exception. That is the only thing it means. It does not mean that you're a failed trader. It does not mean anything. Weekly range profiles based on direction plus high impact news drivers. So these are the things that I was talking about when I was talking about rule sets, when I was talking about choosing the days in which we're going to trade. This is how I determine which days I'm going to trade based on the weekly bias, and these rule sets are imperative, but they can fail sometimes. They also have exceptions. So the basis or the classic or normal bullish week would be when we anticipate a Tuesday/Wednesday low of the week, having the high of the week formed on Thursday or Friday. So the market opens, the market creates the low of the week on Tuesday or Wednesday. So therefore, what we're going to do is we are not going to trade on Monday, Tuesday, perhaps London session. So we're never going to trade on Monday on a normal week, and a normal week meaning that we have no FOMC, we have no NFP, we have no CPI, no big rock events. So therefore, we're going to trade on Tuesday, Wednesday, and Thursday. And then if we are going to only stick with the direction to the upside for this case, then we're going to only trade higher. So we're not going to trade for the weekly closing. If we're looking for an NFP Friday bullish week, then we anticipate a consolidation on Wednesday and Thursday, trading Monday, Tuesday, and Friday, expecting Friday to create the high of the week. So instead of an NFP week, because the NFP is usually in the first week of the month, and we're going to see initial volatility at the beginning of the month, because there are a lot of people interested in going into trading at the beginning of the month, we are going to have a slight continuation on Monday. And this is my opinion of interpreting this rule set, because this rule set was given by ICD. Not necessarily the reason, but this is how I internalized it. And instead of NFP weeks, what we're going to do is we are going to trade Monday, Tuesday, and Friday, expecting a consolidation around Wednesday and Thursday. If we're looking for a CPI Wednesday bullish week, then we anticipate consolidation on Tuesday and Monday, anticipating Wednesday CPI to create the low of the week, having the high of the week formed on Thursday and Friday. So if we have CPI on Wednesday, then I will anticipate the market to either consolidate or do some form of manipulation on Monday and Tuesday, but mostly the day ahead of CPI, I would anticipate the market to just consolidate. Then I anticipate the weekly manipulation to be formed inside of the CPI. And then I'm going to trade after CPI on Wednesday, Thursday, and Friday. And if we're looking for a Monday bank holiday, bullish week, then we anticipate consolidation on Monday and Tuesday, having the high of the week formed on Thursday and Friday. So if we have a bank holiday on Monday, then what we're going to do is we're going to never trade Monday. We're never going to trade the day after, because these days are going to be hectic and these days are going to consolidate. So I will only trade based on having the Monday bank holiday. I will only trade on Wednesday, Thursday, and perhaps Friday's AM session, if we're indeed looking for a form of a continuation. Let me just sip some water. Same thing is seen inside of the bearish narrative. So I do not believe it is essential for me to say the same information. But you can pause this, you can take notes, and you can study this on your own, but I'm not going to go through it. And right now I'm going to show you quickly how we visualize the weekly AMD, or the weekly accumulation, manipulation, and distribution. So this right here, the Sunday's opening price, is where we're looking for the opening, where then if we're going to anticipate the market to go lower, we're going to anticipate the market to form the high of the week to create the manipulation to the upside. And then after Thursday, what we're going to do is we're going to anticipate the market to drop. And this is where we trade. We trade after the Tuesday half of the week has been formed. Therefore, all of this movement on Monday and Tuesday is absolutely skipped, and we never have to go through any losses, and we skip a lot of movement which is against our bias. Same thing here. And this is also viable for Wednesday CPI. So besides, just remove Tuesday here. Wednesday manipulation, which would be the CPI day. Monday, Tuesday accumulation, and then we will look for a down movement towards CPI after the CPI, and same thing for a bullish scenario. Therefore, if my bias for the week is higher and it's determined using institutional order flow signatures along with market structure elements on a weekly chart, then the next step is to look at the high impact news drivers to determine the days in which we will trade. For example, inside of an NFP week, based on my bullish bias higher, as I saw the market create an intermediate term low with a candlestick prior to this week, I want to see the market expand higher from X price point, and I will go with a bullish bias for Monday, Tuesday, and Friday. So what this means is basically we just literally skip over Monday and Tuesday, and we lose a lot of risk, if you can say that we lose it. We do not engage with the market. We have the risk of being off the market when these exceptions come through. But these rule sets, I promise to you that they're going to help you more than not, because this rule set will absolutely save you from trading sort of the manipulation of trying to go long, and then when the real distribution happens throughout the week, you'll be too scared to take a trade instead of the correct direction because you failed to understand the accumulation, manipulation, and distribution. And with this strategy, if you can name it a strategy, with this logic, what you do as a high probability trader, what you do is you just go into the days in which you already know you're going to eat, and you are just going to eat. That is it. You do not care about what Monday does. You are just going to look for information to be taken from Monday and Tuesday. Daily range expansion. Inside of a bullish daily bias, we're going to anticipate the low of the day to be formed in London. This is a classic low of the day London daily range expansion, nothing too fancy. But instead of a bullish daily bias, we're going to have the low of the day formed in London. We're then going to have an AM rally, a lunch consolidation, a PM rally plus a PM closing. So this is the normal classic buy day, in which we're going to again have the low of the day being formed in London. We're going to have the AM rally, the AM going to the upside and reversed for a bearish bias. We're going to have a form of consolidation inside of lunch. And then for the PM session, we're just going to have another rally. So that is why the daily bias is very important. The daily bias is very important for the main reason of identifying these daily range expansions, in which we're only going to look for AM session and PM session. And we are solely going to look for these days in which the AM is going to rally or the PM session is going to rally, or both. So the next profile is where we have a consolidation inside of the London session. We have the AM session creating the low of the day. We have a lunch rally / consolidation. And then we're going to follow up with a PM rally and closing. So this is when the London session consolidates. And this is where our model, the previous session model, absolutely excels. Where the London lows are going to be taken, we're going to create the low of the day inside of the AM session. We're going to either have a lunch rally following the low of the day or consolidation after the AM expansion and then the PM rally. And then we're going to have the situation where the London session creates the rally. We're going to have an AM consolidation, a lunch consolidation, and then we're going to have a PM rally. So this is when we, as AM session traders, we know that the AM session is going to consolidate and we're going to stay on the sidelines. Mainly because we've had the majority of the movement being created in the London session. Therefore, if we have a daily bullish bias, which is predetermined on a weekly chart, and we already have a pre-selected day to trade in, then if we consolidated inside of the London session, which is ideal, then I anticipate the London lows to be taken, expecting a plus market structure shift if we're going to talk about a bullish scenario, and this is what plus and minus means inside of my trading. Expecting a plus market structure shift inside the 950 to 1010 or 1050 to 1110, targeting the London highs. And as a bonus, there is information to be taken in the first hour of trading instead of the 9:30 and 10:30 hour. For instance, if the market consolidates between 9:30 and 10:30, then the market will trade higher during lunch, 10:50 and 11:10 or 11:50 to 12:10. So this is just a bonus point for AM session traders. If we have the low of the day being made in London, I will anticipate some form of retracement into a 15-minute PDRA, fair value gap, then a continuation higher, knowing that we already trade inside of the continuation. So if we have indeed the low of the day being created in London, and we never anticipate that low to be taken, then what I will do is I will wait for the market to go back into the 15-minute PDRA of either a fair value gap or an order block, and inside of the same macros, inside of the 950 to 1010 or 1050 to 1110, I will seek a market structure shift, not expecting the London lows to be taken. And this is a real chart example in which we have the daily NQ chart. This was an example from May. So I have this trade on YouTube. It is completely for free. You can go and watch it. I have all the execution live, fully done. And this was a CPI week. And what I was anticipating instead of the daily chart, and what I was anticipating instead of this day that we're currently looking at, was for the market to go higher. So I was having a daily bullish bias. So therefore, what I anticipated inside of a 15, my apologies, what I anticipated inside of a 15-minute chart was for the pre-market sell side to be taken, knowing that the London has created the low of the day. And why did I choose the pre-market? I chose the pre-market because these lows were made with the CPI event, and all of these retail traders that were chasing this long, which was indeed the correct direction, were having stop losses below these lows. So they've had their stop losses below these lows. So I was waiting patiently for the 9:30 to 12 o'clock to capitalize on these stop losses. And I knew that the market was going to leave the London lows in position for the low of the day. So this was the daily chart before the market has opened at 9:30. I'm just going to show you the screenshot so you can see that this is real. Like, this analysis was real. And I've also did this analysis inside of my what I anticipate for May to do video. So you can go into my YouTube channel and see that one where I predicted this whole entire movement. And it is not for me to brag, it is for you to study, to understand how I saw the market. But basically what I saw here was the market going back into this fair value gap, making it efficient, and then we left it, making it a balanced price range. Then we left this one. I was anticipating the market to go for this March buy side liquidity. So this would be a breakaway gap because we left and we've created an intermediate term low. Then we were trading here. We traded above an inversion fair value gap, which we would already anticipate to be an inversion fair value gap. I never anticipated the market to go below this BPR dealing range for the reason that I've talked with you right here. And also we've closed above the daily inversion gap. So therefore, the only probable reversal point would be the weekly order block opening, which is an inversion, and the upper half of this daily inversion gap, which would leave these open, which would also close this entirety of the fair value gap. And this is the tape reading where we had, this was not a CPI day. I do not really remember this one, but this one was an absolute beautiful example where we indeed used the information that was between 9:30 and 10:30. We had the London lows being taken, and we had a sell stop rate right between 9:50 and 10:10, and eventually an anticipated market structure shift. Here, using the PDRA of inversion gap, we were targeting the London session buy side liquidity as the London session was taken, the London session lows. We were trading instead of the weekly distribution to the upside. So all of this down movement, I faded all away, and I was anticipating all of this movement to be made inside of the AM session, as I saw all of this as weekly and daily manipulation to form the low of the day inside of the AM session, taking the London lows inside of the daily inversion gap. And as you can see here, this is an intermediate sum low. Market never goes below it. Market forms a swing low. So this now becomes intermediate sum low. If we're going to look at this low here, the market never touched the consequent encroachment nor the 75%. So this is a sign of strength. Market closed above this inversion gap, which we would already anticipate. Then market created an immediate rebalance, which means that we're going to see speed and distance within the next 2, 3 to 4 candles. And because we've had a sell stops raid below this low, I then anticipate that until we get to the London session buy side liquidity, we're never going to see this low being taken, as this now becomes a balanced price range. And this is an intermediate sum low. This is also an intermediate sum low. Looking at the 25% of this inversion gap on a 15-minute chart, which is this one. Look at how the bodies of the candlesticks close here. Then we close above the 50% of the inversion gap. We then use the 50% of the inversion gap to go into the high. We open above it, close above it, never come back into it. Knowing that this is a balanced price dealing range, this would be a measuring gap from this low up into this high. This would be the implied dealing range. So we knew that this was a breakaway gap beautifully, and this is a sign of strength. Immediate rebalance here, supporting the idea of this breakaway gap. And then we beautifully reached this level of buy side. The 50% between this level of buy side and this level of buy side, market retraced, never went below this immediate rebalance, and only went inside of this order block. We had the first PDRA, which was the fair value gap, the second PDRA failing, which was the order block, and the third one, which never failed. Market went higher. You can see the swing low being formatted here. Market never went below this low. And then the market expanded higher, taking on this high and taking on the London session buy side. So, finishing this beautiful teaching, what I want you to do for your own study is go in and study weekly highs and lows in hindsight, and then add them to your own journal, and study daily highs and lows in hindsight and add them into your journal. What this does, along with the high impact news driver calendar for that week or for that day, what this does is it allows you to see how many times this reoccurs, in which situation this occurs, in which situations the exceptions come. And this would be the video. Hope you enjoyed this one. I'll see you in the next one.